The financial views and opinions expressed by the host and guests on this program do not necessarily reflect the viewpoints of 1077 The Bronx, Rider University, or Certified Wealth Management and Investment. The material discussed is not designed to provide the listeners with individual financial, legal, or tax advice.
Show me the money!
Where's my money, man?
Here comes the money!
Here we go.
It's time to grow your bank as 1077 The Bronx presents Master Your Finances with Kurt Baker, a certified financial planner professional with certified wealth management and investment. Kurt and his team of financial guests will help you turn those singles into seas of green and plan your financial future accordingly. Now here's your money managing host for the hour, Kurt Baker.
Welcome to Master Your Finances. Are you curious about how established investors see private markets? Do you want to learn about a unique market space in private equity? Serial entrepreneur Ben Jen will discuss how investors source transactions, the people involved, and how his firm, 1435 Capital, conducts due diligence. Ben will share with you strategies you can apply and utilize daily to gain a deeper understanding of how markets work based on his years of experience and involvement in over 300 startups. As co-founder and founder of executive, strategist, investor, and mentor, he will make you feel intrigued as he provides you with a perspective about markets not commonly shown. Ben, you've got an awesome story here. Before we get started, if you wouldn't mind, because there's a little story behind the actual name of your company, the 1435. You want to tell us a little bit about that and how you came up with the name of 1435 Capital?
Sure. So our offices are located in Carnegie Center, behind the Princeton Junction train station. And those 1435 stands for, so the width of a standard gauge railroad track is 1,435 millimeters. So, it plays a little bit to the fact that, capital and the markets never really stop moving, and the trains usually move a lot quicker, and they move up and down rails. So it's more of a, illusion, or I guess alliteration to how capital markets move, just the same way that freight and railroads move as well.
Okay, well, freight moves a lot, and it sounds like you have lots of cars in your train, from what I can understand. So maybe tell us a little bit about, you've got such an amazing background. Tell us a little about how you got started.
Sure.
Because I know you started pretty young, and, what kind of intrigued you about this whole, idea of investing and so forth when you were, was this something you did in your crib? You were, looking at the things around you, figuring, well, how can I multiply my toys here?
maybe not so that early.
Okay, what got you kind of sparked along the way?
Sure. I started off as an entrepreneur in high school.
Okay.
Actually in high school, I didn't even know I was, really interested in entrepreneurship. I was actually more interested in pursuing medicine at the time. So, it's just it's a very different environment, obviously. But, I started off with entrepreneurial aspirations in high school.
Okay.
Had, an exit or two earlier on. And, over the years, I've had a lot of different startups and a lot of different ventures throughout the tech space, with my most recent exit being in telecom.
Okay.
And then, I sort of burned out from doing startups one after the other, and, decided to say, all right, look at the other side of things. What does the investing side look like? Especially from, I had a lot of experience. Well, I had a bit of cash lying around from all those exits.
Right.
And, looking to see what opportunities there were. I basically fell into the angel investing space, and eventually evolved with several portfolio exits along the way. To larger investments and to more later stage investments as well. So.
Okay.
So at this point, I'm a little bit all over the place in terms of my investments, in terms of my portfolio.
Yeah, so you start off in medicine, right? So you had an interest in that. Were any of your early on investments in that? Because you were acting as a principal. So I just want to get some real base, because not everybody really understands how this happens. Here you are in high school,
Sure.
right? You're listening to the teacher talking about biology or something. Look, hey, did you see a need, or what kind of got you going as far as? Usually there's some kind of spark that kind of gets you viscerally
Sure.
interested in something, and you go from an interest to action. So can you kind of describe to me how that worked in your mind? What got you really kind of excited, and then when you went from excitement to I think I can actually do something about this?
I don't think. Well, in retrospect, I don't think I've ever had that much of a interest in medicine as much as I did in anything else. Because I think I guess I focused on medicine, but as a career pathway. But when I got into college, I realized it really wasn't for me.
Okay.
Because I spent more time working in my startup, so more time focused on anything else but my schoolwork.
Okay.
I was never in class, or if I was in class, I was, never paying attention.
Okay.
That's for sure. So,
because you had all these startups going on, right? So can you just tell us a couple of the early ones? Like, what did you get? What did you start up? What kind of a business was it?
it was a tech support company.
Okay.
It was IT tech support company. Nothing fancy, nothing sexy, so
Okay.
to speak. It just grew to a larger company, a larger platform, and eventually saw an exit. At some point earlier on, and then I've done other startups along the way, mostly in the tech space.
Okay.
From healthcare EHR platforms to more in ed tech as well.
Okay.
But mostly focused on tech. And then I fell into telecom as well because it was a natural segue progression.
Okay.
But yeah, I mostly in the tech space.
Okay. Yeah, so obviously I was a little tech savvy. So now were you you were the guy clicking the keys on the keyboard, or are you the person that found somebody that helped you do that? Were you kind of the visionary? Like, hey, here's something that I think we need as far as education. I know that's a big one,
Sure.
education technology, where we shifted from just handing people books and maybe doing something that's a little more interactive.
Once upon a time, I knew how to code, yes.
Once upon a time, okay. So you do know how to do, but it doesn't sound like, I'm sure you're not doing that now.
No,
so
no,
you move
no,
on and you're like,
right.
okay, that's great. So you're more of the visionary, right? You see a need, right? And
Yep.
so and then you go, hey, I think that we could do something a little better than what's out there.
Right.
So you're kind of seeing that, and then you solve the problem, right? So you've done that. It sounds like quite a few times yourself.
Yep.
And then you said, hey, that's great. I'm a principal. You're the guy that gets up at 4 a.m. and is making sure everything happens, and then you got to you close that at midnight or whatever it takes, right? You just because you're the guy that has to make sure everything happens.
Right.
You said, okay, well that's great. I've had some successes. And now let me go help others do that. And I think one of the things a lot of people, maybe you can talk to us a little bit, is that when people get involved in if I'm an entrepreneur, right? And why would I bring in an angel investor or another investor when I'm already being pretty successful? Maybe my business is rolling along and doing okay. Just can you speak to that, why they come in? Because you offer something a little more than just the bank. The bank writes a check and says, hey, send me a payment every month.
Sure.
But you're doing a lot more than that, right? When you get involved.
I mean, a lot of startups don't really qualify for bank financing. A lot of banks
Right.
require, several years of pro forma and several years of history, either with the institution itself or just in general. And usually almost always involve a personal guarantee of some sort.
Right.
Versus a company might seek startup funding because they're looking to grow their company. They want to staff. Maybe they want to staff up. Maybe they want to grow operationally speaking. Maybe they want to add an additional line of business. Something that would be capital intensive that they can't get from a traditional bank loan or a traditional lending scenario.
Right.
So typically they go and go on a little roadshow, and then they go put together a deck, and then they go pitch to different investors to kind of see who's interested in who would get involved with their ventures. Typically, you want an investor that can also help from an operational perspective and to provide something of value besides cash.
Right.
Because having cash is great, but having the operational experience to carry it to the next step is even better.
And that's kind of what I was really, because I know that, and especially as a young entrepreneur or a new entrepreneur, it doesn't have to be young, right? Somebody that's shifting from, let's say that, I work for corporate America, I go into work, I do my little thing, maybe I'm very good at it, but when you go out on your own, there's no HR department, there's no, you don't make a phone call and say, hey, Joe, can you go over and fix this for me?
Right.
It's you. So you have to get all this stuff together, and when you're young, these mistakes can be extremely costly in either time and or resources.
Of course.
And in some cases, it could put you out of business if you make some serious mistakes. Now, somebody in your position that's done this multiple times. So how does that work when, let's say we get together, it looks like there's a nice match because it's a little bit of a marriage kind of thing, right? So,
absolutely.
You have to like me, obviously, because you're not going to write a check and get involved. And the entrepreneur has to like you, too, and feel like, hey, there's a good fit. I think you can kind of help me out. So kind of tell us a little about how that goes.
Sure. As
far as how that relationship gets built initially. Because when they come in your door and give you this deck, right, kind of, and the deck is basically an explanation of what they're doing, right?
Right. It's a bit of a courtship, as you described it. I mean, like ultimately the investor has to feel comfortable with the entrepreneurs, have to feel comfortable with what they're doing. I tell people, ideas are a dime a dozen. There's just so many ideas out there. Executing those ideas is the most important part because people say, oh, what happens if someone steals my idea? Well, great, let them steal it. If they can't execute or they can't put it together, then it's worthless.
Right.
And a lot of people don't realize that, you can have whatever Fortune 500 background, whatever, companies and firms as your background. But ultimately, if you've never ran a startup or if you've never been in a space where you're having to wear 4 or 5 different hats, it's kind of, irrelevant. Mm-hmm. So ultimately, teaming is probably one of the most important things, especially for earlier stage startup. If you don't get along with your co-founders, it's not going to work. If you don't get along with your employees, it's not going to work in some capacity. So having the right team dynamics is extremely important to any early stage company.
No, I think that's critical. But I want to definitely get in that. We're going to take a short break, but I want to talk into that dynamic and how we make sure that all actually works well from the start.
Sure.
You're listening to Master Your Finances. We'll be right back.
This is Master Your Finances with Kurt Baker, Certified Financial Planner Professional. Learn about tax efficiency, liability, owning, managing, and saving your money, and more from Kurt and his experienced panel of guests. Master Your Finances is underwritten in part by Certified Wealth Management and Investment and Rider University. Rider University offers flexible education for adult learners. For more information, it's rider.edu/nextstep.
Welcome back. You're listening to Master Your Finance. I'm here with Ben Jen, a serial entrepreneur, and we've been talking a little bit about how you started with some initially doing a lot of startups yourself. Started in high school, got really good at it, and decided, hey, look, I'd rather kind of get involved in like the investment side and be essentially a consultant, right? You're kind of I don't want to use that word because you're more than that, but you're actually going to assist them with the process of building the business. And I think, as you stated before, many people that are like already working somewhere else don't really understand just how much is involved in actually running your own business and how many stressors there are on you, especially when you're trying to create something brand new that's never been done necessarily, or as a couple of degrees from something that's already been done. So it's a little bit newer. But you mentioned something right before the break that I think is really, really important, is that once you come together with an investor that's going to help you, it has to make sense from a financial standpoint, obviously, and also it has to make sense from a personality standpoint. And then you also mentioned the employees, which I think is great too. So would you mind walking us through, like, how do you determine that, right? How do you determine it's a good business that you want to get involved in? And once you do that, how do you make sure that the culture in the company, that's the company founders and the employees, is going to kind of match with your own philosophy and culture?
Sure. I mean, it's always interesting because a lot of people usually try to put together the best team members or the best people to kind of join a lot of these initial calls, and it's hard to kind of gauge who they really are, especially through just through Zoom calls and just through meetings. But at the same time, or you just even in-person visits, because usually it's I wouldn't want to use the term a dog and pony show, but sometimes it is. They're
right.
putting something together to make it look like, or maybe put something together for investors to seem like they're a cohesive team or something. But usually due diligence takes weeks, if not months, because you're nitpicking every aspect of the business, nitpicking every aspect of their operations, and nitpicking through the team as well. So usually after a few meetings, usually they get more comfortable, more relaxed, and it's helpful to observe people's behaviors and just, especially on a Zoom call, you can kind of tell. Well, on a Zoom call it's a little bit harder, but in person it's a lot easier to tell, how people get along, how teams kind of work, even if it's at a distance. But on Zoom calls it's a little bit more difficult because, usually they're just sitting there, either at home or wherever they may be. But I mean, usually at that point, it's more so if they have some operational track records. Usually, those speaks volumes for themselves. But you never, and I mean, that's why investing in startups is always a major risk, because you never know what may happen down the road. You may never know what may happen, a few months later. So there is always that tremendous degree of risk associated with it, which is why, most people stay away from it, because they're like,
Right.
well, I think statistically, it's found that 90% of startups fail within the first 5 years. So, a lot of people just stay away from it because, well, it's you have to be able to stomach and realize that it might be a complete loss just because something doesn't work out. Maybe the team doesn't work, or circumstances change from an operational perspective, or something else. So you never know.
Right. Yeah. No, I can see that, because I mean, in our business, you want to take kind of the middle of the run, so to speak. You don't want to be involved too early because of the high risk period,
Right.
And you want to wait too long because you might get crushed on the other end of the mountain, so to speak.
Right.
So people that are fairly conservative tend to stay in that little middle range, which you're kind of outside of that, which is obviously important. Otherwise, we'd never get what we have. I mean, it would never happen.
Exactly.
So,
Right.
So you go through the due diligence. So I think it was interesting how this sounds a lot to me, from my perspective, almost more of a personality assembling than it is like necessarily the plan itself. It sounds to me like, and maybe I'm reading it wrong, but it sounds to me like you're paying a lot of attention to the people involved, because if you have the right people involved, you can solve problems, right? If the right team is together. But if you have, no matter how good the business plan, if that doesn't work, it's just going to fail.
Correct.
Right. So even if the plan might have some faults,
Yep.
you can maybe pivot. Right. So you get to a certain point, and you're like, hey, maybe it's not going to work exactly the way we thought.
Yep.
But maybe we can move and try this instead. And let's just. So what kind of experiences have you seen along those lines, like figuring out the teams and like things that might change along the ways? What are some of the things that you see happen in some of these companies?
I can't I can't begin to tell you how many times if I've invested in something, and later on they pivot or change because for whatever reason they realize it wasn't going to work, or maybe a key team member leaves because they found something else, or they're moving on from a career perspective. And sometimes it's all you can do is sit back and watch and see what happens. But and when you mentioned earlier, kind of like a consultant, more like a mentor and advisor to a lot of these companies.
Right.
Because effectively, it's in my best interest to kind of guide or steer things towards a better outcome for the company, and for my investment as well. So. That's usually why I usually don't touch companies or don't touch industries where I don't have a lot of operational experience in, or I don't have a lot of background that I can provide or help in. So usually stick with what I know in terms of investment perspective, which turns out to be a pretty wide swath of companies.
Right, over 300 companies. That's a lot. So you obviously are doing something right, because you have a much higher success rate than 1 in 10.
Right, and
So that's a pretty amazing thing all by itself.
right. I mean, there's definitely a fair share chunk of companies that haven't succeeded along the way, and
Right.
But for the most part, I wouldn't say lucky, but I would say that I think definitely having a hand or a say in from an operational perspective has helped tremendously in terms of guiding a company forward.
So for somebody that's thinking about, hey, maybe I need to add an investor, a mentor, an advisor type person to my business model. I'm doing good. Maybe I can do better if I have some additional experience in there. So just from because sometimes they're worried, well, I don't want somebody to come in and like taking over my company, right?
Sure.
I mean, they're going to feel like, but so how does that relationship really work, and how often are you involved and things like that? So if I'm the original entrepreneur, maybe there's a couple of founders originally. What kind of things actually typically do happen? You in there like every day, in their office saying, "Hey, here's what we got to do at 3 o'clock this afternoon, man. Make sure this happens." I mean, what kind of relationship does it end up being usually?
Usually, it turns out to be something more of a I take a board observer seat or maybe a board seat with the company just to kind of provide sometimes it's monthly, sometimes weekly, sometimes quarterly guidance in terms of they'll just ask me on a quarterly basis, hey Ben, this is what I'm working on. These are the things that we've done in the past quarter. These are things we're working on next quarter, and you're usually asking or using me as a sounding board to figure out what are some of the next steps that they should pursue. And sometimes you just need a third party perspective to just kind of hear them out and kind of make a decision as to what they should or shouldn't do. So a lot of times it's call it a therapy session for them, but sometimes it feels like some of them do call it therapy because it's like, oh, you have someone else listening to your issues and problems and kind of providing a bit of guidance as to where they should go next.
No, and I think that's critical because many people, if you're not an entrepreneur, you may not know this, but an entrepreneur is kind of a lonely business because if you're the boss,
right,
everything's on you, good or bad.
Exactly.
And not every day is the best day, so it's nice to have somebody else to talk to that has some experience that maybe has already gone down this path or a very similar path in the past. Because what's interesting is a lot of businesses all have the same essential components, right? You need good employees, you need a good plan, you need to execute it. So a lot of the primary components, you need to put proper systems in place. Do you kind of assist with that, where they say, hey, we're putting this stuff together, and you find things? So what kind of things do you typically find when you're actually doing your due diligence and you go in and say, well, maybe these are some things you might want to think about doing a little differently?
Yeah, most definitely. There are definitely fair share companies that, usually because, they get tunnel vision sometimes. They kind of lose focus on anything else beyond them. And, they sometimes need a reality check or a little bit, or, maybe a course correction a bit sometimes. And it's helpful to have that outside perspective. Say, well, maybe you're focusing on this one thing too much, and maybe you should be, focused on some other broader things, or maybe you should look at, some other alternatives as well. Because sometimes it's difficult if you're working on one thing and all you see is this one part of your one part of the picture. You don't see the rest of it.
Right.
So it's easier to have, not easier, but it just helps to have a different perspective on things. Say, hey, maybe this isn't the only direction you can go in. Maybe there's like a plan B or a different path you can go in.
And I assume they're usually pretty open to those ideas, because I would be if I was talking to you. I'd be like, hey, this guy.
Usually they are. Usually the people that fail the due diligence process, we realize that are more rigid and aren't open to suggestions and ideas and aren't as open-minded as they think they are. And those are the people that would have problems accepting changes and would have problems accepting criticism and feedback. And those are the types of companies that could look great on paper. They could have a revenue and a lot of traction, but ultimately, if they can't accept some criticisms or critiques, it's not going to work out very well.
Oh, that's interesting you bring that up. I definitely want to talk about that. We're going to take another quick break, but I found that part very interesting. You're listening to Master Your Finances. We'll be right back.
This is Master Your Finances with Kurt Baker, Certified Financial Planner Professional. Learn about tax efficiency, liability, owning, managing, and saving your money, and more from Kurt and his experienced panel of guests. Master Your Finances is underwritten in part by Certified Wealth Management and Investment and Rider University. Rider University offers flexible education for adult learners. For more information, it's rider.edu/nextstep.
Welcome back. You're listening to Master Your Finances. I'm here with Ben Jen. And just before the break, we were kind of going through the due diligence process, and you actually mentioned something that I think is very, very interesting to me. So you tend to shy away from founders or owners who really don't take criticism well, which I found very interesting because I think that's important. I happen to agree with you. So what kind of issues, what kind of things have you run into? Like, you're going through the process. Can you kind of maybe give us some stories without like giving us any ID number? No, don't give me identifiers, just kind of a generic scenario.
There's definitely been companies that we've been pretty far along with due diligence, and we find out at the 11th hour that, this one co-founder has an issue with, the way that, the first co-founder is running things, or maybe doesn't agree with the certain investors, or we find out later on that there may be a proxy war waging in the background, and usually those are red flags, like run for the hills and run and duck for cover type of things.
Right.
Because last thing that I want to be involved in is some sort of proxy fight with another investor, or stuck with a board, or stuck with a group of people that just are having serious divisive issues within the company. And there's definitely been quite a few deals where at the last minute we found out that there were issues.
Wow.
And we were fortunate enough to be able to back out of them. But yeah, there's been a lot of those different stories and tales.
Yeah, so I guess that comes down to like you probably pay a lot of attention how the different people that are in power, the different founders, right? Because usually most of these probably have more than one. A lot of these, right? Because usually you creative person and the technical. I mean, that's what I've found. It's typically a couple people that get together and do most of these things.
Yep.
And so how that core original founding dynamic works. Is going to tell you a lot about how when they add one more person, now you're adding another person to that group, right?
Right.
So you're just going to be another one of those cogs in that wheel. Is that going to be a nice smooth wheel that runs nice and runs around nice? It's going to be kind of bumpy, but the chain comes off every once in a while.
Exactly.
That's probably not so good, right?
Right. Yeah. It's usually, usually we look for companies that have more than one co-founder involved, just because, well, one person if it's just one person and. Not to be morbid or anything, but if they disappear, die, or just become incapacitated, what happens to the company?
Right.
The company ends right then and there. So, typically look for investments where there's at least two or more co-founders, and people that have maybe gone along with each other. Have some significant history together. They could have been college roommates. They could have been in high school together or something, but they've had some sort of history together where they've either worked at the same company or done something together. So it's not like pairing two or three total strangers together.
Right.
Usually in those scenarios where complete strangers are like mixed together is when things don't exactly work out, or usually they're trying to still figure each other out along the way. So it's it's a makes for an interesting dynamic there. Or lack thereof.
Yeah, I think it's fascinating to me how a lot of this just keeps coming back down to personalities and how they work together and whether they can solve it. Because as we talked about before, I mean, being a startup or even there's a lot of stressors on these from a market perspective. So you've been involved in a lot of different companies. I'm just kind of curious about. I know you've got the telecom, you had the tech companies.
Yep.
What do you see happening like right now? And what kind of things are you kind of looking at currently, obviously in a generic standpoint? I mean, what things are you kind of interested in, and why do you kind of have some interest in those things? I mean, there's a lot going on when you talk about tech these days. It's like It seems like my mind kind of explodes when you try to wrap your head around all this stuff, right? What kind of things are you trying to like pay a lot of attention to right now?
I mean, right now we're focused on a lot of, I think it's just because they're strictly interesting, is a lot of food and beverage tech companies, and the other thing that we're focused on is a lot of infrastructure companies, which I know the two topics have nothing to do with each other. But there's a lot of innovation as of late in the food and beverage space, between the development of a lot of different machinery and a lot of different advancements in how maybe something like ice cream or frozen treats could be delivered and used in office space or.
To me, that's very dangerous for me personally, because I might sit in front of the ice cream machine all day instead of doing my work. So it sounds great. So, I don't know.
And then from an infrastructure perspective, I mean, like you see around the world between what just happened in India, or just even here in the U.S. We have a lot of crumbling infrastructure between transmission lines and or just road issues, or just everything in general, like infrastructure as a whole. It's pretty out of date. And
so what are some advancements in that? I mean, when I and I'm an engineer, so I have a little bit of knowledge of this, but I mean, just for the general public, I mean, you kind of drive around and you're like, okay, well, you got a pipe that moves water, and you got transmission lines that bring electricity. I'm good. My lights are on. Who cares, right? Until there's a storm and then nothing works. But so what kind of innovations are you kind of seeing out there where maybe we can do this a little bit better, right?
I mean, it's like
fun.
simple things, or not even simple things, but like things like, the more of a push, especially like California is making a push for more electric vehicles, or electric vehicles to be on the road by, I forgot what year, but
2035.
2035, I think,
Yeah.
right.
Yep.
So like, like pushes like those, even however, long and slow, government moves, it kind of pushes the industry towards one direction or another. Especially if more towards EVs and such. We're going to see way more of those on the road in the next 5 or 10 years.
Sure.
And that means the infrastructure to go with it as well, from charging stations to, a lot of them have to do with computer components these days. So, and a lot of it has to do with battery components. So there's a lot of those, changes in how batteries are made, what batteries are synthesized out of. There's a lot of smaller things that are part of the overall infrastructure that people aren't really looking at because it works and it runs, but
right. I mean, you bring up
somewhere.
Yeah, definitely the EV thing. I mean, those are some pretty aggressive goals in my mind. When I first heard that announcement, I was like, wow. That's a pretty aggressive goal if you don't want to sell any more gas, ICE they call them, right? Internal combustion engines.
Yep.
By 2035. That's going to be an interesting transition because one, I keep thinking about, well, that's a lot of juice, a lot of electricity you're going to be flowing around the system if you want to charge all those cars.
Right.
And two, I guess you brought up the charging station and then the batteries themselves, right? We have issues with they work, but how much lithium do you have and how expensive and what are we going to do with the lithium batteries when we're done, right? I know they used to yell at me, don't throw the lithium batteries in the garbage, right? You got to recycle them properly. Well, now you got a whole car full.
Exactly. Exactly.
So that adds a whole nother issue.
Right.
So do you see some of the, I guess these are some of the opportunities you see like, hey.
Oh, yes, most definitely. I mean, it's not just the initial development, it's also, the end of life cycles. It's the whole ecosystem and part of for I guess for cars, the construction of them, where the chips are coming from, where the chips are being made, to the batteries themselves, and every other part of it, including recycling.
Yeah, you mentioned the chips, so I think it's interesting. I guess we heard about that. We had the supply chain issue. We just assumed, you chip, you go down to the local, electronic store and you just pick up your chips. But it's not quite that. Now, I guess we've had a fairly centralized, production. Now, I guess, are they starting to disperse that a little bit from a supply chain issue? Are you seeing any of that? Are there any opportunities as far as the delivery of some of these? Some of them are pretty basic, right? Like a memory chip, right? We kind of take those things for granted, I guess.
I mean, but those are all complex electronics these days.
Right.
They get smaller and smaller and smaller, and there's a lot of complex components and things involved with it. I think ultimately, the U.S. is going to try to make more investments towards that space, try to be more less dependent of Taiwan on chip manufacturing. But it's going to take time. It's going to take expertise, and it's going to take a while.
Right, because these are pretty expensive plants, right? They usually hear like billions, like they don't spend like a couple $100,000 to build one of these things,
exactly.
Right? So yeah, that sounds like a lot. So how do you come in contact with the? I mean, there's a lot happening here, and as you mentioned before, you have all these great ideas. So I guess where do you get this information from? Because I mean, I'm just I'm reading all the publications out there that I read, but your funnel's much bigger than mine probably.
Sure.
Because I'm not getting into minutia of how do you make a chip and what's going to go in my my iWatch or whatever, and whatever the case may be, to measure my heartbeat, whatever. But I mean, they get very specific. Some of these things, right?
Yep.
So how does this stuff kind of come to you? Because you're not the only person doing this out there, right? There's a couple of you out there.
I mean, there's no shortage of people emailing decks, sending me requests on LinkedIn. I mean, at this point, I've had to kind of restrict how people message me at this point because it's just inundated with pitches.
Okay.
And I find it easier just to go to different events. There's one coming up in Florida that I'm going to with my team in December called Venture Summit, where we hope to see.
Was that Venture Summit?
Venture Summit, yeah. In
cool.
December, that we hope to see a couple hundred companies.
Oh, okay.
And there are definitely a lot of startup pitching events as well. That a lot of them are virtual these days, but a lot of angel groups as well. Also, a lot of deals that we see through them as well. So, there's no shortage of deal flow on our part. If anything, we have too much of it. So when people keep saying, "Oh, we'll just send you deals," I'm like, I really don't need another source of deals.
Right. Right.
But it's more so the quality of deals as well, because there's no shortage of well, the run-of-the-mill, I saw it on Shark Tank, they did this, and I'm like, well, it doesn't really translate. What you saw on Shark Tank to versus reality are two different things.
Yeah, you want to explain that a little bit? I know that's maybe we have to take another quick break, but I'd love to hear that comparison because I mean that's the TV version, right? And,
Sure.
and you're like the real life version. So you're listening to Master Your Finances. We'll be right back.
This is Master Your Finances with Kurt Baker, certified financial planner professional. Learn about tax efficiency, liability, owning, managing, and saving your money, and more from Kurt and his experienced panel of guests. Master Your Finances is underwritten in part by Certified Wealth Management and Investment and Rider University. Rider University offers flexible education for adult learners. For more information, it's rider.edu/nextstep.
Welcome back. You're listening to Master Your Finance. I'm here with Ben Jan, and you're talking a little about the quality of the deals. Then right before the break, you talked about, well, just because it was on Shark Tank doesn't necessarily mean that's something that we might be interested in. So can you kind of tell us, because that's interesting. I mean, whenever you're a professional in an area and you watch a TV show about it, you're always like, well, that's not exactly the way things work. So what are your thoughts when you watch a Shark Tank? What's a little bit different or the same, I guess, between the two versions of the show and the reality?
Sure. I mean, I think a lot of people don't realize that due diligence still happens in the background. It still happens, after, the show or after they've filmed it. I mean, there's someone always checking to make sure that whatever they claim is real or exists. And I'm pretty sure that they don't air the ones that don't exist or don't work out. But, there's a lot of, checking off boxes and making sure things happen. But a lot of it, people usually don't have investors clamoring to go invest and throw out random numbers at you, kind of on demand. Usually it's a more like Kurt pointed out in the first quarter is there's a bit of a courtship that happens. There's a bit of it's like the process of dating. There's a lot more poking around and figuring out what the company does, and you don't usually get an offer on the spot, and it's usually not something with some crazy economics either. People usually have the notion that, I'm going to give 5% of my company away in exchange for some absurd valuation, and
Right.
That's not how the real world works.
Yeah, some of those numbers seem a little high to me, frankly. I'm like, I'm not even like in the business. I'm like, wow, that seems like a lot for something you just started, and
Right.
maybe you do or don't even really have something going on yet.
Yep.
But so I guess the due diligence behind the scenes. So that's key, obviously, because people can talk. I mean, there's a lot of great salespeople out there. They can tell the good story, but you got to be able to back it up with the facts, right? Basically.
Right.
So once you do that, and then you got to actually put the actual contract together. So I guess in real life, this is not really like a 1 hour stand, so to speak, or a one night stand. This is a long-term marriage, right?
Of course.
So once somebody goes in and let's say we get together, you invest in the company, and you talk about exits, right? So some people don't realize it. I mean, it's not like a bank. They're going to give you the loan for the next 20, 30 years, and they want you to keep coming back and renewing it every 5 years or whatever the case is. You guys have a plan too. Like you go, okay, well, here's where we're coming in.
Yep.
Here's what we're going to try to accomplish.
Right.
And here's the strategy, right? So it's a lot like I always talk to my kids about, like, when you buy real estate, you're always looking at the exit, right? Like whenever you invest on something, the first thing you think about is, well, how am I going to get out, or when I'm going to get out?
Yep.
And people don't. That's kind of counterintuitive, but that's actually the way you do it, right? So you
Exactly.
kind of walk us through how that part of the process goes,
Sure.
and how it's a little different than maybe some other things people are used to.
Of course, yeah, because we're always thinking in the back of our minds, all right, so what is the exit going to look like? What is the multiple going to look like? What could it potentially look like? Would this company get bought out? Would it be acquired? Would it do a merger and roll into a larger company, with the IPO? There's all sorts of different ways that companies can exit these days. Or they could, there's ways of prolonging their runway on the private markets as well. But there's a lot of different things that they could do. But yeah, it's like always a consideration. It's like, all right, is the company's valuation too high? If it's too high and we're sitting on it for 3 or 4 years, are we going to get a better multiple out of another company that's earlier on that is doing something similar or has a similar story? Or, so these are all factors that we're always playing with in our back of our minds when we're looking at something. because sometimes it's just, oh, we're only getting a 2x, over the course of 5 years.
Right.
We could do that with the markets.
Right. That's true. Hopefully, right? Well, maybe not this year, but usually.
Right. But, it's like, so we're always looking at, what is the best bang for our buck?
Okay.
Almost. Or maybe something we can get a potential 25x return in a possible 5 years versus, so these are all things that we're considering. Obviously, that's not always the case. Sometimes it's something that we really like and really passionate about, and, we'll go with it. But these are all things that we're always sort of.
So there's a certain return you typically go with, like a minimum. Like I'm not going to really. This isn't really worth my time, so to speak, right?
Sure.
To do because it's a lot of work on your part.
Of course,
I mean, you're actually participating in the running of the company to some degree.
Yep.
You're not just like buying the stock and selling the ticker a couple of years later, right?
Sure. I mean, obviously, things always change, but at the back of at least my mind, if I can't get at least a 10x out of it, it's not worth my time.
Okay. And that's over usually how long is the holding? I mean, there are ranges, I'm sure. But what are kind of some typical holding periods that you're looking at usually? When do you want to kind of be out?
Usually 3 to 4 years.
Okay. So you're looking at something that's ready to really kind of go, take off and really kind of.
But sometimes, I recognize that maybe it's going to be a 5 or 6 year type of thing. And it might be, but usually those are earlier companies and maybe a potential multiple could be even higher. So, but those are all things for consideration.
Because you add other things. Now, you talked about a couple of things, and I think I want to delve into that slightly because what decides, what are the factors that say, okay, well, maybe we're going to look for another company to acquire us at some point, right? So there's got to be some kind of affinity that you see when you go into this thing. IPO, which initial public offering. I mean, are we just going to go public and let the world buy us, and then there's some pros and cons to that, of course. Or do we want to stay private and maybe do a few more tranches, maybe some more investing? So that's a lot of different things. I remember hearing a quick story about Elon Musk, he brought Tesla public because he needed the money, basically. But he also has SpaceX private because he says until we figure out a plan to go to Mars, I don't think we have any real value yet.
Right.
So he plans on keeping it private for a while. And some of the employees are like, well, we want our money. So anyway, so the same investor, two different philosophies based on two different companies, right? So what are your thoughts about that?
Well, I don't think we can cover the entire thing in the show.
We have about 5 minutes left.
I think there are certain sectors and certain companies that if it's let's say it's a food and beverage company, maybe they're focused on a specific. Maybe they're one faceted, like it's a water company, for instance. Mm-hmm. They're more likely going to get rolled up with a larger brand like a Pepsi or a Coca-Cola, where they are managing hundreds and hundreds of different products and brands, versus going public on their own. Versus a company like without using specific names. There's definitely, I guess, more or not even software-driven companies. More, I guess, let's say aerospace, because you mentioned Elon Musk. Okay. Aerospace companies that would require a longer runway that they could probably seek a lot of private financing for, because space and the prospect of going to the moon. It's
very
Mars
sexy, right? That's kind of cool.
Very sexy and it's very exciting.
Right, it is.
So usually they can stay private and do a lot of private rounds that way. Mm-hmm. And even early investors can seek liquidity on the secondary markets. In the private secondary markets, where existing investors or cap table holders sell their shares to a new investor. So there's a lot of different ways to seek liquidity and get exits out there. But again, this the answer could take a whole segment in itself.
Right. Yeah. So you might prolong. So basically, it just sounds like it depends on what market they're in, like what you're trying to accomplish, and how it may happen. Like when you're doing something really difficult, like space, literally, we really haven't done this to this kind of fashion, right? We're just not sure what this is going to end up being.
Right.
Whereas a beverage, we've done a lot of those, right? So you can kind of know. I mean, locally we had Bai that was bought out, a few years back, and he did pretty well with that. He mixed it up, I don't know, in his bathroom or something. I don't know where he made it originally, basement, I think. But he, now he's off making liquor or something. I don't know what he's doing, but anyway, so it's so once you get the templates down, so these are a lot of different business. So what would you say to somebody who's out there thinking, all right, I've got a great idea, or maybe the next stage where they've got something going on? What should they be thinking about from their perspective? Like, how do I get myself ready?
Sure.
For somebody to come in and maybe join in with me, help me really kind of grow quickly?
I mean, ultimately, investors like to hear a story, and I think in general, people like to hear a story. You know, having a good story and have a good history as to, you know, I mean, putting together a deck and having a good story that goes with it. You know, how did you start? How did you, you know, progress? You know, what made you go into the industry? What made you find a solution to this industry? And, you know, why are you the group to take it to the next level? Why are you the group of entrepreneurs to make it work? So telling a story from a progression perspective and where you could take it and how you could potentially exit, and you know, a lot of people omit, especially they're raising money. It's like, oh, well, you know, they kind of forget or leave out, why are they raising money? You know, how much are they raising? You know, I don't know how many countless pitches I've seen where people just gloss over those details. Well, as an investor, that's what I want to know: how much money you're raising, what you're looking for, and why are you raising it? And a lot of
what are you
people-
going to do with my money, basically,
Exactly,
right?
exactly.
I hand you this large amount of money. What exactly do you plan on doing? It? Going to
Right.
put it in the bank and make a CD rate or something? No,
Exactly.
Not, we don't want to hear that, right?
And a lot of people forget, you know, that, you know, that's all part of the story and all, you know, part of what the investor is looking for. So, you know, it's helpful to make sure to remind people to wrap those components into their pitch.
Yeah, so that's interesting to me. So somebody's going out searching for money, like they put together a great story about why they did it, why they're passionate, which of course sounds like a founder to me, right? I saw a
Exactly.
great idea, I saw something I need to do, I found a need, I accomplished it. But when they go out and they're looking, because they were bootstrapping this thing all along the way, right? They were like, you know, and they're willing to give up everything and eat ramen noodles for the next 10 years if they have to, but they want to make this happen, right?
Right.
But when you add a large influx of cash, sometimes people are like, that's great, but you have to actually know what to do with it. You don't want it to sit there.
Exactly.
And so thinking about that, now is that something you might assist them with? You say, look, here's what, or do they really need to know this is where we see this going, right? They have to really have a pretty clear idea.
They may not have to know 100% where it's going, but at least a pretty good plan or idea of, you know, maybe 20% spent towards operational, or 20% towards operational, 30% towards R&D.
Okay.
You know, some sort of breakdown as to where they're spending the money. Usually when people say, oh, I'm going to use it to spend on my personal salary, those are usually, you know, turn-offs. I'm like, I'm not giving you money to go spend on yourself. I'm giving you money to go spend on
They're
your
not going to go shopping? We don't want to hear that, right?
Right, like, oh yeah, we're gonna use it, you know, to go live off of. I mean, yeah, I understand entrepreneurs need money to live off of, but at the same time, you know, people are raising money so you can grow the business and grow operations out. So at a later point, you could be comfortable enough with giving yourself a salary type of thing.
Right. So we're running out of time here. So you have any last minute tips for anybody out there thinking about this is a path they might want to take for their company?
Yeah, like, you know, I think, you know, making sure that you have a clear and concise story and, you know, knowing kind of what you want and are looking for, and putting it together in a cohesive deck. There's no shortage of decks that are floating out there on the internet as well, in terms of good decks and bad ones. Mm-hmm. You know, making sure that someone looks it over, maybe practice a bit before you get out there and pitch to a real crowd is helpful.
That's awesome, Ben. We really appreciate you coming on. Everybody been listening to Master Your Finances. Have a great day.
That's all for today's episode of Master Your Finances. Miss Kurt Baker's biggest money managing tip, or even a full episode? Head on over to masteryourfinances.us or 1077thebronx.com/masteryourfinances. Look for Master Your Finances on Anchor, Spotify, or anywhere you get your podcasts. We'll see you next time, only on 1077 The Bronx.